There are two types of people that look for storage. The ones that chase everything and the ones that know exactly what they're looking for. Now, when I first got started in this business, I was the former. I was the one chasing everything, and I didn't really even know what I was looking for. I was overwhelmed. I was frustrated. Quite honestly, I was stuck. And everything changed when I built a simple checklist that gave me clarity so that I knew exactly what type of storage deal I was looking for in the exact market. And that's what most people have. Most people get involved in storage and they're not even really sure what they're looking at. They look at deals online on LoopNet and Crexy. They look at deals on Facebook groups and they stop before they even start because they don't have a personal deal filter. Now, having this checklist completely changed the game for me. In fact, so much so that I was able to get my first storage deal, a 340 unit storage facility, because I knew exactly what I was looking for. And most importantly, everyone in my network and ecosystem knew what I was looking for. Now, in this video, I'm going to break down that simple checklist that you can swipe and copy and model yourself so that you can go out and find your first or your next storage facility. Let's dive right into it. So I'm going to go ahead and dive into my storage deal avatar, and I'm going to share with you exactly what you need to do in order to evaluate deals, in order to look for the right deals in the right market. So let's go ahead and I'm going to share with you right here. Now, this is the same exact Storage Wins avatar that I created about 5 years ago. Now, I've modified it since, and I'm going to walk you through this document so that you can go ahead and use the same exact deal filter criteria, or you can take this and modify it to your liking, because depending on your goals, you may be looking for something different than I was looking for when I first got started. Things evolve and things change. So this is a living, breathing document that you can always come and add and change depending on your goals, depending on your situation. And by the way, there's going to be a link, a pinned comment below this video where you can go ahead and download this avatar buy box checklist so that you already have a starting point. And then again, you can use it to modify it yourself. Now, I've broken this down into 4 or 5 categories, and I'm going to walk you through each one and explain why it's so important to have clarity around this aspect of your avatar checklist. Now, the first thing that you want to consider is what type of market do you want to be in? And what types of facilities do you want to go after? I was crystal clear that when I got into this business, I wanted to get in contact with mom and pop owners. In other words, I was not out there looking for the beautiful 3, 4 story buildings, class A, like a Public Storage. That's not what we're looking for. We're looking for the mom and pop operated storage facilities. And I'm going to dig down a little bit deeper in this video and explain to you why that's so important. Now, in terms of the markets, right, you have big metropolitan cities and markets such as Miami, where I live. You have secondary markets, which generally speaking have a population of 500,000 to a million and up. Think of cities like Tampa as an example, as a secondary market. And then you have what I like to target, tertiary markets. This is where you have less competition, more mom and pop operators. You're not going to have any of the big players like Public Storage, like Extra Space coming into those types of markets. So I really like to focus on tertiary markets. And generally speaking, these markets have a population anywhere between 5,000 and 75,000 people, give or take. That's just a rule of thumb. I do think it's important that when you look at tertiary markets, you do want to, ideally, you want markets that have a population in that sweet spot. Let's say 10,000 to 75,000. Now, it's not to say that you shouldn't buy a facility in a market that has 3, 4, 5,000 people. Just understand that that can come with some potential risk, because if somebody comes in and adds, builds storage and adds more inventory to the market, then you may not be able to fill up your facility because you just have an oversupply. It's overbuilt. And when you have a market with a really, really small population, you can't really control the population. There's nothing you can do there. So, but with many things I'm going to share with you, it's a rule of thumb. So let's just say 5,000 to 75,000 people in terms of population. And this is a biggie, medium household income. I like to look at tertiary markets that have a medium household income of $50,000 and up. Now, ideally, I can get north of $60,000. And I learned this lesson the hard way, that my very first storage facility I bought in a market where the average medium household income, I think it was like $27,000 a year. $27,000 a year on average. Now, the problem with those types of markets is that they don't have disposable income. They don't have discretionary income. A $50 a month in rent on a storage unit is a much bigger impact in their world than where if somebody that has a medium household income of 50,000, 60,000, 70,000. So in those types of markets, you're going to have higher collection issues. You're going to have a greater delinquencies, which means more management headaches, more collections issues. Oftentimes that those types of markets have higher crime. So trust me when I tell you, you want to avoid those types of markets, even though thankfully I bought it right and I did really, really well when I sold that facility. But you do want to be in markets that have a medium household income of about 50,000. Now, one caveat to this is, I don't want you watching this video saying and completely disregarding a market that might have $47,000 medium household income. Again, this is a rule of thumb. These are just small pieces of the puzzle. And what we want to do is we want to collect all these pieces of the puzzle, put them together to see what the story tells us. And then we can make a decision based on our specific goals. And that's what this checklist is going to help you determine. I've already mentioned it. We're not looking to be in markets where there are REITs. A REIT is a real estate investment trust. It's institutional money. These are the players that own the five largest, which is Public Storage, Extra Space, Life Storage, CubeSmart, and U-Haul, right? So generally speaking, I'm not looking to be in a market where we have one of these big players, these big REITs within a 5 to 7 mile radius of the facility that we are looking to potentially buy. Also, and this is really important, one of the reasons I look at mom and pop operated storage facilities is because many times it's just poorly managed. They don't have any marketing in place. They don't have any systems or automation in place. It's not uncommon to look at storage facilities that don't even have a website, right? Where the majority of our customer base comes from online traffic, whether it's search engine optimization, Google My Business, pay-per-click marketing. There's all this. Most of our customers come from online. In fact, I think it's close to 80%, right? We run an unmanned facility model, which means we don't have somebody sitting behind a desk. So you can't even walk in and rent a unit. Well, you can, but it's all digital. It's all mobile, right? You scan a QR code, it takes you directly to our site where you can rent a unit online. And that's one of the reasons I love this business is because of the technology, because of the automation, because you can be anywhere in the world and manage these facilities remotely. And that was not possible 30 years ago, right? The advancements of technology and everything that's going on allows us to be able to buy and operate these facilities from really anywhere in the world without having to have staff or employees on site. So we are looking for self-managed, poorly managed facilities, ideally preferred. Now, let me dumb this down for you, right? It says supply index, square foot per capita. Here's what that means, right? We want to be in markets where the demand for storage is a lot higher than the supply for storage, because that gives us the ability to push the market street rates. In other words, we want to be able to raise the rates so that we can generate more revenue and ultimately have a higher net operating income, which is what ultimately determines the value of the facility, the value of the business. So the national average, right? And this fluctuates, but the rule of thumb is you want to have a square foot per capita under 7. What does that mean? That means that the amount of net rentable square footage within a 5 mile radius relative to the population, right? You want there to be less supply and more people because that's going to drive up the demand for storage. Now, look, I have bought facilities that have a square foot per capita of 12 or 13, right? Much higher than the 7 that we look for. So it doesn't mean it's not a deal and you shouldn't buy it if the square foot per capita is over 7. Back to what I shared earlier, this is just one piece of the puzzle. Our job is to collect all the pieces of the puzzle, put it together, and figure out what that story tells us, and ultimately determine if it makes sense to pursue it. And if it doesn't, what would make it a deal? That's one of the things I always share with coaching clients is if it's not a deal, what would make this a deal? Is it price? Is it terms? Is it a combination of both? And so those are one of the things that you definitely want to keep in mind. Now, when it comes to the square foot per capita, I used to calculate this manually, and now I have access to a tool called Tract IQ, which will tell you not just the supply and demand in the area, but one of the things that's super, super important with storage is you want to check with the city or the county's building department to see if there's any open permits for storage supply coming in. In other words, is there somebody right around the corner from your potential facility building a storage facility, right? You're going to need to know that going in because imagine if you buy a storage facility and then 3 months later you have a 40,000 square foot facility that opens up 2 miles down the road. Believe me, that is going to impact your ability to raise rates and increase occupancy. It's going to be a challenge because now the population, your potential customers in that market, they have more options. There's more supply of storage, which is going to drive your prices down. It's certainly not going to allow you to increase your prices. That can have a really big impact on it. So Tract IQ, again, it gives you the building pipeline and it tells you if there's anything coming online into that market. So you guys can actually get a 50% discount if you click on the link that's in this document. Again, to get this document, all you got to do is click on the pinned comment below, and then you can access the document. You can click this link, or you can just head over to tractiq.com/Pardo. Tractiq.com/Pardo, and you can get 50% off, at least at the time of this video. Now that we've talked about the type of market, the type of facility that we're looking for, let's talk about size, right? So does size matter? And I would say yes, depending on your goals and depending on your situation. So one of the things that I knew coming into the storage business about 5 years ago, right, after being involved in real estate for now nearly 2 decades, is that it is just as much work to evaluate, underwrite, analyze a small deal as it is a big deal. And oftentimes, I might even argue that it's easier to close on a bigger deal than it is a smaller deal. So when I came into storage about 5 years ago, I had the mindset that I'm going to target mid-sized facilities. And what I mean by mid-sized facilities, and this is subjective, right? Everybody might have a different take on this, but I was looking for storage facilities that had 20,000 net rentable square feet and higher. Now, this was contrary to a lot of people that got started around the time that I got started. Oftentimes, people default to what makes them feel comfortable. And a smaller facility that doesn't have a high of a price tag makes people feel comfortable. And I understand why. In their mind, it's less risk. But I had supreme confidence that I could do this, not because I'm special, not because I'm super smart, because I can assure you that I'm not. I'm just like you, just a regular dude. But I know that when I commit to something, I'm going to figure it out and I'm going to surround myself with the right people that can help me, that can coach me, that can guide me. And I had this mindset that the only way that I would fail is if I quit, right? If I didn't believe in myself. And so I said, well, if I'm going to put forth the time, effort, and energy, why not go after the bigger deals where the pie is bigger and it could just make more sense? So for me, I knew that it was going to take just as much time, energy, and effort. So I said, okay, let me target facilities that are between 20, 25,000 net rentable square feet, all the way up to 60,000 square feet. And it's so interesting. They say that what you focus on expands. And I think because I added that to my storage avatar checklist, my buy box, my very first storage facility was 43,000 square feet, 340 units. Now, I can almost but assure you that if I would have said, hey, I'm going to target facilities that are 8,000 square feet to 15,000 square feet, I probably would have bought a facility in that range because that would have been my focus. So there's no right or wrong here. I'm just kind of sharing with you my mindset and why I decided to target the mid-sized facilities. Now, when you start getting anything above 60, 70,000 square feet of storage, now that's where a lot of the bigger players operate. They're looking for the larger facilities. They're not, a public storage and extra space, a CubeSmart. They're not going to be looking at a 15, 20,000 square foot storage facility. It doesn't make sense for them. It doesn't fit their model and what they look for. So that's why I kind of tend to like that 20 to 60,000 net rentable square foot range. But again, I'm going to keep stressing this. This is a rule of thumb. I am not saying that I wouldn't buy a storage facility that was smaller. In fact, I just had a coaching client less than a month ago, which I'm a part of that deal, close on, I think it's an 11,000 square foot facility, but it was in a good market. The numbers really made sense. So you have to evaluate your situation, your goals, what you are trying to accomplish in storage. It's interesting when I have conversations with our Storage Wins coaching clients, I always ask them, I said, hey, what's your goal? Are you looking for cash flow? Are you looking for equity or a combination? And oftentimes the answer is either cash flow or a combination. And when I start to peel back the layers of the onion, what I really have come to realize is that many people getting started in this business, they're looking to generate piles of cash, right? They think they want cash flow and they do, but that's more of a long-term goal, right? Many people come in and they're looking to replace their income from their W-2 job, or they're real estate investors that are just tired of chasing deals. They're burnt out. They're sick and tired of the income roller coaster, and they're looking to generate piles of cash that then they can take and put into the right facility that can generate consistent, predictable cash flow. So I want to encourage you to think about your goals and your situation, get some clarity around that, because that can really help you dial in this storage avatar checklist, this buy box. So what else? I was looking for markets. Obviously, we just talked about the importance of supply and demand. I was looking for markets that had more demand for storage than supply. I'm a terrible rehabber, right? I've done many, many, many real estate deals throughout the years, got started in late 2005. I've done my fair share of fix and flip, and I don't like big projects like that. I don't enjoy it. So I was looking for low CapEx. Now, what is CapEx? CapEx is just, it's a shortened word for capital expenditures. It's the money that we need to put into the facility to improve it, right? And that could be painting, that could be adding a brand new automated gate, that could be fencing the facility, that could be some roof work, that could be new doors, springs, hasp. That all falls under the umbrella of CapEx, capital expenditures. I was looking for something that wasn't going to require six figures worth of work in order to get it up and running and operational, right? For me, anything under $50,000, was kind of in my zone. And again, what you focus on expands. We ended up putting about $27,000, $28,000 worth of CapEx into my very first storage facility. And the bulk of that was just adding an automated gate so that customers rent a unit online, they get text to gate code, they can put it in, and boom, they can access the facility. Hands off, automation, love it, easy peasy. And then the other thing that I looked for is there the ability to expand? In other words, if you are in a market that has demand for storage, you ideally want to have extra room on your land, on the dirt, so that you can either build more storage or you can add portable units, right? There's things called box wells that come in. They look exactly like storage units, except they're not fixed to the ground, right? They just come on, they drop them, and you can rent those units just like you would any other storage facility. So in an ideal world, I was looking for room for expansion just so that it gave me the option to expand if I chose to. All right. Location, location, location. I am going to stress this one no matter how obvious it seems, because keep in mind, when I bought my very first storage facility, about, I don't know, what was it, 4 years ago or so? Yeah, 4 years ago when I bought my first storage facility, that 43,000 square foot facility, I violated this rule. I shared with you earlier, I bought in a market that was high crime, where the average medium household income wasn't, forget 50,000, forget 40,000. I don't even think it was at 30,000. And I really cut my teeth on that facility and I learned a ton. And I'm grateful for the experience. And it's interesting, they say that you make your money in storage when you buy. You just realize it when you sell. And that is so true. That's exactly what I experienced in this facility. Held it for about 3 years and ended up selling it late last year and did very, very well in the sale. But it came with more management headaches than was on my storage avatar checklist, right? And that's one of the things, that's why I shared earlier that use this, model this, tweak it, modify it, but it's a living, breathing document. As you learn, as you grow, as you evolve in this business, you're going to come back to this and you're going to realize that, hey, you know what? Now I think I'm going to tweak this. I think I'm looking for this. I think I want this. So I was looking for anything that was a direct flight out of Miami, nonstop. I wasn't looking for, two-way connections and all that kind of thing. And one of the questions I get asked pretty often in storage is, hey, how often do you have to travel to these facilities? It's funny. Sometimes I talk to people that think like I'm traveling every month to our facility in Amelia Island or to Ohio or now to Illinois. And it's like, no, 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 no. In fact, every facility I've owned, I think I haven't visited I haven't visited a facility more than 3 times. On average, I usually go twice. I go once when I'm under contract to perform due diligence, and then I go a second time a day or two before closing, and then I'll stay a day or two after closing. After that, once you get your boots on the ground set up, once you get the management and the operations dialed in, there really is no need to go visit these facilities. I find that for many operators, it's more of a comfort thing to go out there, see it, walk it, feel it, touch it. But in my experience, it just really isn't necessary, at least no more than once a year, unless you buy a facility that needs a complete operational overhaul. Occupancy is extremely, extremely low. That could be different. That might be a time where you need to roll up your sleeves and be out there a little bit more frequently. But I'm big on finding the who, not worrying about the how. So for me, I was crystal clear that I was looking for something that I could run and manage remotely. Wasn't going to require me to be there, certainly not more than once a year. And then I was also looking at the southeast part of the country. I live in Florida, so I like the Georgia, the Carolinas, Tennessee, Mississippi was part of my storage avatar checklist in the beginning. I'm not really targeting Mississippi that much anymore, but Virginia, Louisiana, Kentucky, markets like that. And then my personal preference is I like to focus on the red states, not the blue states. It's not that I wouldn't buy a facility in a blue state. In fact, I was looking at a facility yesterday in New York that looks pretty decent. I was looking at it with a private one-on-one coaching client, and the numbers look interesting. And so we're looking at that facility. So it's not to say I wouldn't buy here. It's just a preference. I'm putting it on here because, again, what you focus on tends to expand. So do not violate location, location, location. Make sure that you're buying in the right markets based on everything I shared earlier in this video. Now, here's a big one, price, right? Here's what I'm going to share with you. I don't like to filter based on price because my belief is that if the deal works and the numbers make sense, I can find the money, right? I don't have to have $5 or $10 million in my bank account to go buy a big facility if the numbers make sense. If it's the good deal and it checks all the boxes and it makes sense, I'm confident I could go find the money, right? Whether that be through a bank, whether that be through an equity partner, whether that be through private money or even seller financing, one of my favorites. So there's several videos that I will link below that I've shared on how I've been able to buy all these storage facilities without using any of my own money. And the limiting belief that you need money is one of the very things that holds people back from getting involved in this business. But as a if you want to feel better about price range, I would say 500,000 to 2 million. When I first got started, that's what I initially put. That number has since expanded. I'm not really limiting myself based on price point because of all the things I just shared. Now, as we start to kind of wind down here, I want to talk to you about the investment strategy. And I've touched on some of this a little bit, but personally, I was looking for light value add opportunities. Now, what does value add mean? Value add just means that when you take over the facility, what are the things you can do to improve the operations, increase efficiency, and increase the overall revenue and net operating income of the business? So when I bought my very first storage facility, some of the things I did was like I mentioned, I added an automated gate, right? I painted parts of the facility. We added some cameras. We increased the lighting, better lighting in the facility. We added signage, right, throughout the facility in different areas. So those are some of the things we did. We raised the rates, right? Because one of the things I liked about this deal was that the rates were significantly less than the average market rates. So we were able to go in there, raise the rates. We were able to go in there and add tenant protection so that now that increased our revenue. Whenever we got a new customer and existing customers, they had to get tenant protection. So those are just some things you can do from a value add perspective. Of course, we added a website. We introduced systems and automation, technology, like I've talked about, and we had plenty of room to expand. Now, I didn't end up expanding, but we had the room, and it fit what I was looking for. Now, in terms of the deal profile, when I got into the business, again, I wasn't looking for a big operational overhaul. So I was pretty much looking for facilities that had occupancy of 60%, I should say, and up, 60 to 85. You do want something that has meat on the bone. You want the opportunity to grow the income. One of the things that I like to look at is what is the in-place revenue? In other words, what's the revenue that the facility is generating today and then compare it to the potential revenue once you increase the rates and you do some of the things from a value add perspective that I just talked about. So I'll look at the gap between the in-place revenue and the potential revenue. And I like to be conservative. I look at the potential revenue at 85% occupancy. In other words, I never evaluate, analyze, or underwrite a deal at 90, 95% occupancy, and certainly not at 100% occupancy, because whenever I speak to storage owners and they're at 100% occupancy, that just means they're not charging enough. They're leaving money on the table, right? They have the ability to increase the rates and they either don't know it or they don't feel comfortable doing it because they think they're going to lose a bunch of customers. And what they don't know is that even though they might lose some customers, they're still going to generate more revenue in the long run by doing so. And one of the things I always share with coaching clients is you want to put pressure on the market street rates, meaning you want to be ideally the market leader in terms of pushing the rates and increasing the rates, putting upward pressure on the market. That's really, really important. And then because of my background, because I've been a full-time real estate investor and entrepreneur since late 2005, I love direct to seller deals, direct to owner. I bought two facilities from a broker, and I bought several direct to seller. So it's not that I don't work with brokers. I enjoy building relationships with brokers, and you never know where the next deal is going to come from. But I do prefer direct to seller, direct to owner. Now, as we start to wind down here, and before I get into the deal killer checklist, I want to share with you why what I've just shared with you is so important. So when I got started in this business, it's interesting. I didn't have this. I didn't really have the clarity. I didn't really have the direction and the guidance. I felt that my experience as a single family residential real estate investor was just going to carry me through. And I was just going to be doing storage deals every month. And I got a rude awakening 2, 3 months into this journey where I wasn't really seeing results. And a big part of that was because I wasn't doing the work. And the reason I wasn't doing the work is because I didn't have clarity about what I wanted and what I was looking for. That's why this storage avatar checklist is so important. And it was when I got clarity about my investment goals, the market, the deal profile, everything I've just shared with you, and I put it on paper. And then I took it a step further. I published that with everybody in my network and ecosystem. Literally, when I got on the phone with people and I would make outbound calls to investors, wholesalers, people in my mastermind, just anybody I would connect with, I would tell them, hey, here's what I'm looking for in a storage deal. Here's what I'm looking for in a storage deal. What do you got? Have you seen anything? Like I was giving them a reason and incentivizing them to reach out to me whenever they saw these deals. And sure enough, I had a good friend of mine that I was working with at the time. He sent me a text message and he goes, Alex, check your inbox. I think I found your first storage deal. And so right away, eager and anxious, I jump into my inbox, I pull it up, and boom, I see this 43,000 square foot facility in Mississippi. And I start looking through it. And I'm like, yep, yep, yep. Now, the one thing that it violated was location, 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 right? It was not in a good market, but I bought it right. I was getting it at the right price. Now, the only reason I got that deal, mind you, the person that sent me this deal is very well known, has a huge network, knows a lot of storage investors and operators, and he could have gone to any of them. I was literally the first person that had the opportunity to buy this deal because I had shared with him exactly what I was looking for. That is the power of having this clarity and having this document, which again, if you click in the pinned comment, you'll be able to download this, get it, modify it, use it, tweak it to your liking. Now, here is the caveat before I get into the bonus here. The caveat is don't box yourself in so much, no pun intended, right? Don't put yourself so much in a corner that, hey, I'm only looking for this. Like I mentioned earlier, these are pieces of the puzzle. Be flexible, be nimble. This is going to give you clarity about what you want. But what I love about this, and one of the things that we talk about in our Storage Wins coaching community, is that when something fits outside your buy box, outside your storage avatar criteria, your checklist, but it's still a deal. Just because it's not a deal to you does not mean it's not a deal to somebody else. And those are opportunities to wholesale these facilities. I've wholesaled several storage facilities, some for six figures. And it was because it was a deal, but it just didn't quite fit what I was looking for. Or maybe I was in a season where I had a lot going on. There was other projects, deals I was working on, and it just didn't make sense to onboard another facility. So it's important to create this, and don't box yourself in so much that you prevent yourself from receiving other opportunities. Okay. So give yourself an out, share with people what you're looking for, but it's a general framework, right? It's not a hard and fast rule. You get to control what this looks like. Now, the bonus, avoid high crime areas, right? Check with the police department, right? Find out, has there been, a lot of break-ins at the storage facility? If you're in a market that has demand for storage and the medium household income is healthy, right? 50,000, ideally above 60,000. But do your homework. When you go under contract, and you're going through due diligence, you want to connect with the police department, talk to local businesses in the area because they know the area. They know if there's crime in that area or not. When you get on site, are you seeing a lot of like vacant, boarded up, houses? I remember when I bought my first facility and I first got on site, I was driving down Highway 80 and I was starting to see like abandoned, boarded up motels. In fact, there was an empty, abandoned shopping center right behind my storage facility. Now, I didn't know much about storage at the time, but I knew that wasn't good. It just didn't prevent me from moving forward because I felt very confident I was buying it at the right price. I could increase value and ultimately sell it for a nice profit. And that's exactly what happened. But it did come with more management headaches than I anticipated and that I wanted, right? So it was a learning lesson. So avoid major crime areas. And depending on your situation, you may be super comfortable with taking on a big project that has low occupancy or that you have to put a lot of money into. I personally was not. But you definitely, these are the last two, super important. Avoid markets that the population is decreasing or declining, right? You can check tools like Tract IQ. Again, if you go to tractiq.com/Pardo, that's going to take you here where you can get a 50% discount, which is huge. Tract IQ can give you that information. You can also go to census.gov. Census.gov, that'll give you some demographic information. Now, it's not going to give you the square foot per capita, building supply, all that type of stuff that we spoke about. But census.gov will tell you if the population is increasing or is it decreasing, right? Are there jobs coming into the market or are there people leaving? Are companies leaving? That's not good. You want to be in a market where there's growth, and you certainly don't want to be in a market that is overbuilt or oversupplied. So I want to encourage you, if you like this video, check out one of these. I never know where they're going to show up because you'll really appreciate those. But here's a call to action. Click on the link below. Download this document 100% free and use it, model it, modify it, tweak it. Start to gain clarity about what you are looking for in your first or your next storage facility. So with that being said, I hope you enjoyed this, and I look forward to the next one.